Good morning, everyone. Welcome to the final day of FII and a particularly exciting chat about capital allocation. I'm told this is very much the investor day, so I hope you're here for some brilliant insights from our panel. Let me introduce you. We have Zoe Cruz, the founder and CEO of Menai Financial Group. We have Josh Harris, founder of 26 North. Jeffrey Jaensubhakij, who's the group CIO of GIC. Dan Moorhead, founder and managing partner of Pantera Capital, George Walker, chairman and CEO of Neuberger Berman, and finally, at the very end, Anne Walsh, managing partner and CIO of Guggenheim Partners. Now, we're going to be talking about alternative investment, which is clearly a huge market, over $20 trillion, still growing. But is the easy money era over? And I'm certainly hearing concerns in the hallways of FII and behind the stage about the size and sustainability of some of the asset classes. I'd like to start with you, Anne. Why don't you just lay it out for us? How is the alternative markets sort of area performing so far this year, and what are your expectations going ahead?
So I think the strength of the alternative markets is evident, and I'm very optimistic for the future. We have to define alternatives, I think, at the outset, which is it's a very large and expanding market, maybe just beyond the public markets for bonds, stocks, and of course cash, of which there's trillions of dollars sitting on the sideline ready to be deployed into all sorts of opportunities. So I think year to date, we've seen good results. I think we are going to continue to see that in the future. If I think about the macro backdrop a bit, I think the opportunity is definitely there to take advantage of the ever-increasing size of the private capital markets as we see the shift from public markets more to private, from traditional bank lenders to the private markets, and that includes private equity, private credit, private asset-backed lending, and the like. And so I think we're going to continue to see this expansion as we see this migration of capital. And this is happening not just in the US, but also quite strongly globally as well.
Josh, how much of the performance do you think is tied to macroeconomics?
Yeah, look, I think it's much less than other asset classes. I mean, obviously, what you're doing is you're trying to, I mean, macro obviously affects everything. I mean, in a big downdraft, you get, dragged down. In the big updraft, you get dragged up. But to a large extent, you're holding for longer. The whole point of macro is the whole point of alternatives, they're less liquid, and you can they're more absolute return driven, and so you can kind of wait through environments and kind of create value by fundamentally making investments that you sustain for a longer term. And so I think that while everything is driven by macro, obviously alternatives probably has a little bit more staying power through macro. And so I think that, look, I think what's happening is that certainly alternatives, private assets are outperforming public assets, and so you're going to continue to see them expand. But on the other hand, I do think that the party's a bit over when, since for the last 15 years, every time you bought something, interest rates went down, and it was worth more than it was the day before. So people kind of a little bit got used to that. They lost their discipline. And the lower interest rates carried everyone up, which is the macro, obviously. And now what we're seeing in the last few years, obviously, is a stabilization and uptick in interest rates. That's going to make it, kind of back to where we all started, which is you got to make money the harder way. You've got to buy well. You've got to, help the companies or the investments, and then you've got to sell well. And so I think that the fundamentals are shifting. There's also a lot more capital. You've got people in this region, other regions. It's globalized. You've even got the retail investor coming in. So all of a sudden, you've got a lot of supply capital. So we could talk a lot about it, but I think that the party is a bit over. But it's like everything else. There'll be a shakeout. There'll be an industry structure shift, and then the good alternatives firms will get better, and the ones that are probably less good will be gone. So that's probably healthy for the industry.
I feel like that was the first warning shot fired, Zoe.
I'm pretty blunt, so.
Is the party over?
I don't know, but I made my career dealing in probabilities, probabilistically derived outcomes. So I kind of step back and look at, on a scale of 1 to 10, is the party over? Are we at 10? I am a believer that there will be opportunities. I agree with Josh. But how big the downdraft is going to be is, so I think we're maybe at 7, 7.5. The asymmetry of risk reward, which is to actually get that additional return, you're going to need to take increasingly more risk. And the reason I feel unequivocally strongly about that is when I joined Morgan Stanley in the early 80s, and what made my career is overnight rates were 21% on their way to zero. And 30-year treasuries, risk-free rate of return was 15% on their way to 2. So 60-40, 40-60 didn't matter. That party is over. So since all of us are looking at risk-adjusted returns, I would believe in the traditional asset classes, we're not getting paid enough for the risks we're taking. It's a very big, broad statement, but I think this quest for risk, we're not looking enough at risk-adjusted returns. I believe the opportunities are enormous, and a lot of people talked here in the last few days about the huge opportunities. I agree. But in my career, which spans many, many years, I've never seen, and I use the word never very sparingly, the fat tail risk being as fat as it is. So.
Who agrees with that? Anne, Jeffrey, we haven't heard from you.
Yeah, I think Zoe's pointed out something that is really apparent to all of us, which is that there's heightened uncertainty in the world around politics, geopolitics, technology, even climate change. But a lot of assets are priced at the highest valuations, as if that uncertainty didn't exist and as if it didn't matter. And I think, if there's any lesson that we get from high valuations is that, when the catalyst comes, the drop can be very high or very tall. And so I think that's a risk that, the fat tail risks out there, that's in probability terms. I think in terms of actual potential losses are also there. I think that means that for allocators, you have to be especially careful, whether as a GP choosing between companies you're investing in or as an allocator across asset classes. You have to construct your portfolio well to be able to take some of that potential volatility.
The chat I've been having frequently appears in the Speaker's Lounge and in the halls of FII is about something called private credit. George, explain it to us in simple terms, what private credit is and why there's been such big growth here.
Private credit is a whole series of different strategies. Often you read about it in the press. It's called shadow banking. I think the way that most folks have started investing in private credit was originally providing senior loans to sponsors, which have produced terrific returns for folks over time. And now the definition of private credit has expanded significantly. So what was first corporate credit now is really turning and pivoting towards asset-based credit. And folks are finding that they're able to earn far higher returns than in public credit markets by accessing these loans directly as opposed to participating in public markets. And it's becoming a challenge, frankly, also you've seen a lot of banks talking about this as being problematic, is the role of the bank. A lot of these loans historically were on the bank's balance sheets, and now we are putting them on the balance sheets of GIC and retail investors and other places, which I would argue in a broad sense is probably good for the world, that these sorts of loans are on the balance sheets of very long-term investors and not sort of levered, guaranteed financial institutions.
Yeah, so the growth in private credit, obviously private credit, private equity, private assets, the reason that they've grown so much is that they've traditionally beaten the public markets on a risk-adjusted return basis. There's been a trade of liquidity for return. Obviously, as all this money flows in, right, it gets a little bit harder It's not as easy. But truthfully, private credit, as George is saying, continues to be the best place to hide in a really somewhat overvalued fixed income market. You can probably achieve 300 plus basis points of excess return per unit of risk in certain strategies, and that's attractive, right, for a portion of your portfolio which is not liquid. And you don't need to necessarily. There's also some question, and we could debate for a while. How liquid are the public markets? That's sort of a whole nother existential question. And are they really that much more liquid than the private markets? So there's all these things, but by and large, almost all private assets now are more competitive than they were, but they're still probably better than the public markets generally.
And there's probably less regulation, which I'll come on to. But first of all, our AI avatar did weigh in on the subject of private credit. And obviously, we'd all love to hear from her or him. I forget if it's Sean or Sophia. It's Sean. Sean, take it away.
Good morning, everyone. Let me add my view. Private credit's $2.1 trillion market may be a ticking time bomb. With 20% covenant-light deals, and 1/3 of borrowers struggling with interest costs, we may actually be blindly racing towards another 2008-style meltdown.
Never one to mince the words. Anne, ticking time bomb.
Well, so we've mentioned the fat tail risks, and I think that's true because there's a lot of cross currents. For those of us who are U.S. investors, particularly in fixed income, we've seen the end of the bull market in bonds in the U.S. This tends to usher in a period of time for other types of investments to take more center stage. And one of those areas is credit. If I look at to oversimplify, two risks that I tend to look at together as being the ones that when they work together in the worst possible way tend to create this market seizure moments, and that is a lack of liquidity and leverage. And usually when those are taken together, a high risk that is leveraged, that's a significant problem. But right now we don't see that because there's a lot of liquidity in the system. And as I mentioned, there's $6 trillion sitting on the sidelines in cash in the US, for example. And there's a lot of money that's still being deployed globally that's available to make investments. So I really don't see those two elements coming together at this time, or frankly, in any kind of time frame in the near future. And the $2 trillion that's gone into private credit is really just sort of migrating from banks. So it's not like we've really increased the total amount outstanding in private lending. It's just we've shifted the holders from banks, traditional investors, and moved it into the hands of other institutional credit providers. So I tend to think of these not as the risks that I'm really focused on at this moment, but there are a lot of cross currents, and there's certainly a macro backdrop right now of investment deployed into new areas, whether that's sustainable energy or artificial intelligence, case in point, our guest speaker, and any number of other investments, including population shifts and the like that are happening right now, reshoring, and those are creating opportunities for private credit investors at the same time.
You have beautifully, oh, sorry, George.
I just would add, we manage about $30 billion in sort of 8 different flavors of private credit. By and large, the investors, if you had to group them into 2 types, one would be large institutions. They're often taking their exposure down in public equities and allocating to private credit. And that private credit is often without leverage or with very low leverage. So that's inherently de-risking the system. Both that investor is taking less risk, moving from equities to credit, and it's taking it out of a concentrated, levered, government-guaranteed banking system. The other place is with retail investors, and again, typically with very low leverage. What I do think we're going to find, to Josh's point, is the area's grown quickly. There are lots of firms who do it. Some are very good at credit, some are very good at marketing, and it's hard to tell by looking in the rearview mirror who has great credit expertise because we've been in such a benign period. And so right now, if you look at historic risk-adjusted returns, they don't really tell you much about the quality of the underwriting. What folks have to do is really look under the hood and look at the loans and how many have had amendments and the like. And then, I think when the tide goes out, and there will be losses, but they're probably going to be smaller losses than folks would have experienced in their public equity book. And there will be people who did a good job and people who did a poor job, but folks need to really underwrite the quality of the credit underwriting.
May I add something to that? I agree 100% with those comments, but I would say my advice to all of us asset allocators is there is not enough stress testing of our assumptions, and there is the broadly held assumption. There's plenty of capital. But when I look at demands, AI alone, they were quoted as $6 trillion worth of capital needed. So we're talking about trillions with an S. So one assumption we're making, there's a lot of available capital to be put to work for all these opportunities. And the other assumption is actually liquid asset classes are in fact liquid. I can tell you as a foreign exchange trader, and I mean, you remember long-term credit? These were Nobel laureates, brilliant strategies. They made one wrong assumption. What they thought was liquid became very liquid. UK gilt market, this is an ancient history, 2022, sovereign debt of the UK ceased. It collapsed basically in terms of value and price. And so for me, the energy industry, and I know at Morgan Stanley we did a lot of stress testing of our scenarios, that if your assumptions turn out to be wrong and you go bankrupt, whatever it is you have is too big. So, I remember in 2007, I came back from California, and this brilliant mortgage originator said, Zoe, you guys, you're talking about complexity, opaqueness, so you really are looking at assumptions that if you say you're going from mark to model to mark to market, you're all in trouble. This is in 2007. Equities were making new highs, fixed income knew Lehman was dead. So for me, and again, I don't know that this is the outcome, but it's a non-zero possibility, and we all need to stress test our portfolios. If those assumptions are wrong, what does your portfolio look like?
I want to move the conversation on to opportunities and different asset classes, and one that poses a really interesting question, both in terms of liquidity and democratizing investment, is of course digital. Dan, why don't you walk us through your thesis here and whether more investors should be exposed to digital assets?
Yeah, I think it weaves into this macro story is that there are no working age people that have invested in a rising rate environment. Bonds started rallying in 1982, and the Fed has basically bailed you out of any potential mistake you've made in investing. And so without the Fed to bail you out, you have to look for new assets, new opportunities. And I think the fiscal monetary situation the US and other countries find themselves in is pretty precarious. The US is running a record deficit with the most wonderful economic statistics. If anything bad happens, it will get very ugly. And inflation's still debasing your money at 3.2% a year. If you let that happen over your entire lifetime, you lose 90% of the value of your currency. So you have to look for different asset classes. Another way to think about it is alts really are not alternative anymore. It's 20 trillion. When I started in hedge funds in the 80s, there's probably 20 billion in alternatives. With 1,000 times more money chasing things, it's harder to find returns. So you have to find something with an excess return and low correlation to the rest of the financial assets. And everything is totally correlated now, right? All risk assets go up and down together, and it's not because there's any intrinsic correlation between the cash flows of these assets. It's because everybody's portfolio is the same. We all own the same stuff. And so I believe blockchain has an important role in a portfolio because it's totally uncorrelated with risk assets and has an amazing expected return. The correlation over the last 13 years of Bitcoin as a proxy for our industry with the S&P 500 is 0.1. So it's one of the only major assets out there with zero correlation. The amazing thing about the returns, though, is our first fund has an 11-year compound annual growth rate of 83%, which sounds amazing. When you compound it for 11 years, it's up 1,000x. So if you can find an asset where you can get 80% return per year with zero correlation to the S&P, you have to have a tiny bit in your portfolio.
Other than Zoe, who is, of course, purely invested really in the digital world, the other four, are any of you invested in digital assets like crypto?
In a very modest way.
Listening to that argument, why so modest a way?
Say the first is fiduciaries were just hesitant to go new places, so want it to be more proven. Frankly, I think the problems with FTX and others set the industry back a while. We were probably closer a few years ago than we are today. One, and second, for us, just in our experience, and we've been doing some clever things in sort of Bitcoin put writing and others. During the 5 years or so that we've been playing with it, our investments at least have been far more correlated to NASDAQ than we had hoped. We had hoped it would be more diversifying than than our experience narrowly has been. But you're looking at more idiosyncratic opportunities than we are.
Is there anything, Zoe, that you think?
But if we could earn an 83x, we'll.
I was going to say, rubbing your hands.
We'll look for opportunities to re-underwrite that.
It's wildly volatile, and it's driven by things that are not fundamental, right? So if you're a professional investor, you're managing institutional capital. It's driven by the supply and demand for Bitcoin, right? So as a family office, you can buy a little Bitcoin, and it has definitely performed. But why is it going up? So the question is, as a fiduciary, as an institutional investor, you're managing people's capital. What is your thesis, right? And the thesis that was espoused, the fact that it's acorrelated, for a small amount of time, it's hard to really project that into a fundamental business opportunity that you should ask your clients to go into.
Can I?
Please.
You can go to Vegas also, right? And,
Oh.
The
twirl
what?
the
Sorry?
roulette wheel. No, I'm saying you could go to Las Vegas and
okay.
take a bet, and you're likely to be 49%, right? 49% of the time.
Zoe, have you based your whole career on gambling?
So,
I wouldn't.
So sadly, Bitcoin sucks the air out of the room. It is interesting. 30% of our funds are in Bitcoin. It's basically store of value. It has a second wind because the US government has $34 trillion worth of debt, and neither candidate for president is going to do anything about it. In fact, the budget they both are going to turn in is $2 trillion on top of $34 trillion. So that's an interesting use case. My generation buys gold, which is a negative carry position, but it's reasonable to put 50 basis points in gold in a negative carry thing. My younger son buys Bitcoin, so it's a generational thing. The reason I say it sucks the air out of the room, the reason I'm in this industry, in this asset class, is you're talking about actually a very new way of exchanging value. We're tokenizing and fractionalizing, if that's a word, real assets, where you own a building or you own an apartment or you have small amount of money or you're a producer of something, whether you're a journalist or a singer. So the fact that you and I can exchange value, not just money.
Easily.
Value without a bank account, that's the revolution.
This is what I've been excited about, the democratization of what has, up until now, I'd say, been a very opaque, mysterious world of private equity firms and, frankly, quite hard to access. Right. I put this question to our AI avatar, Sean or Sophia, who knows, and asked them what they think about tokenization, whether this will democratize these assets. Let's listen to Sean.
Let's see. The latest figures I've analyzed suggest that tokenized alternative assets are projected to reach $16 trillion by 2030. But while Wall Street touts democratization, 20% of these deals lack traditional projections. Are we naively handing the keys of a $16 trillion kingdom to retail investors, and just how will regulators hope to keep pace?
So may I just
We got three, yes, quickly.
The retail investor I'll come back to, but I want to talk about the justifiable opprobrium that this industry has. Lots of shysters in it. Yes, FTX was a disaster, and I'm glad it happened because it took a lot of the shysters out. The largest fraud in history was a public company, regulated company called Enron. The second largest, nothing to do with digital assets. The second largest fraud most recently was called Madoff, nothing to do with digital assets. So sadly, fraudsters...
You're saying shysters are shysters no matter...
Fraudsters abound, so that's what I would say. But in terms of the retail investor, again, we're talking about of the half of the population in the world is underbanked or unbanked. I was on the board of All Mutual, and some of our meetings were in Kenya and in Nigeria, so it's easy as an American to say, all this doesn't matter. This is before Venmo. In Kenya, you had people that didn't have shoes that were conducting electronic banking. So for me, this is a revolution that goes much deeper than buy Bitcoin and you'll be rich.
We're going to go to Jeffrey for the sort of sovereign wealth opinion, and then on.
Yeah, no, I think some really good points have been made, and tokenization, democratization of finance, if the efficiency of the digital asset technology is such that you can have these transactions quick and cheap, that's great. I think the problem with tokenization of some of the assets is that at the end of the day, the question remains, how do you actually extract the value from those assets when it's split up over thousands of owners? So for us, if we own a building and we needed to sell the building, we go and find one buyer who will buy the whole building. If it's spread out over 1,000 tokens, how are the 1,000 people going to get together to sell that asset in order to really realize that value? I think that's a difficult question to solve. But I think the last thing, which I think is the most important, is that I think most investors, we underestimate our ability to withstand illiquidity. And so we look backwards and we say, well, these assets have always been pretty good. The GPs have always returned this much money every year, and so we can buy this amount of assets because we can stand this amount of illiquidity. But when crises happen, the amount of illiquidity is up tenfold, and we find that actually we're strapped for cash. And if that's so for institutional investors that have various different means of accessing liquidity, how much more so for retail? So I think you have to ask still, what is the illiquidity appetite of the ultimate investors that all these assets are being sold to? And I think this is something that if we don't do it right, eventually the regulators will step in. And then, that's probably not what we all want.
But again, to me, you solve for that in terms of the percentage of assets you allocate to this. More than 5% of your liquid net worth, whether you're retail or institution, is not correct. Zero allocation to this space is also wrong. There are pension funds that invest at 50 basis points where they don't get fired if they're wrong, because the price volatility is absolutely insane. But this is a Cambrian explosion of activity. A lot of things will die. Of the 19,000 tokens, you don't need to do a lot of research to get to 500. Of the 500, we do a lot of research to get to 100. And of those 100, 50, 60 will go to zero, but there'll be 1,000x. I agree with Dan. So for me, do enough where you care to get educated about what is the revolution really about. And you will find it's a disintermediating model that will disintermediate a lot of, whether it's music, Spotify, etc. So that's how I would answer that. Don't put your money into this where you get fired if you're wrong. But it's very, sorry, go ahead, please.
Okay, Dan.
I don't want to monopolize
Dan's been
this.
desperate
As you
to
can see, I'm
bust it.
passionate.
If you asked a think tank to create a product for financial inclusion, they would want these features. Anyone on earth can use it, cell phone-based, borderless, permissionless, instantaneous. Migrants don't have to pay a month's wages to their remittance company anymore. No SWIFT or bank fees, payments at a tiny fraction of the 300 basis points Visa, MasterCard charges. Free to store your money, free to send your money, yields. You can access your money 24/7, 365. No more bank bailouts. Central banks can't devalue it. No inflation. It actually goes up 83% a year. Totalitarians can't repress it or steal it. Women in countries that don't have economic rights can use Bitcoin. And then banking the unbanked. There's 4 billion people that don't have access to bank accounts. Complete democratization of finance. All of this open source, given to the world for free with no patents. Satoshi already did it. That is Bitcoin. That's why it's so huge.
And maybe why we don't need intermediaries like George here. George.
Exactly. It was going to make a different point. I think what Jeffrey said is super important, which is focusing on folks' liquidity budget. And I think a lot of what's happening around alternatives right now is a function of where people are. Where you see lots of large US and European more mature funds that have more retirees perhaps than contributors, is they're already at where they want to be from an illiquidity perspective, and they'd like to allocate more capital to private credit, and that's created stress in private equity. So right now it's a quite challenging private equity fundraising environment, combined with the fact that distributions from private equity, particularly from venture, have been low. So as you quite different, frankly, from retail clients who right now, if you were to go to Morgan Stanley or Merrill Lynch, they might be 98% liquid, which frankly is probably too liquid. They have a large illiquidity budget that they can put to work, as do many of the folks in this region who are responsible for younger funds with a longer term horizon. So the big change we see is sort of pressure in traditional private equity, where there's a big opportunity to be a liquidity provider to that space. So secondaries, continuation vehicles, co-investing, and the like is one big trend, while folks are trying to figure out how to allocate more to private credit and perhaps crypto and other things that we're less involved in. And so I think those are the broader structural dynamics that are taking place, but have to be, what Jeffrey said is so important, which is folks really have to be clear on what their liquidity budget is and deal with it. And right now, different sorts of investors in different regions are in a very different place.
Different regions in a different place. Jeffrey, traditionally, the US is, of course, where we see kind of the biggest returns. Is that going to shift?
I think it will, for two reasons. I think the US has been, the most amazing economic model that exists. It's the most, kind of complicated but efficient capital market system. So not only are there a lot of companies to invest in, but there are a lot of financial products that support that ecosystem that investors can easily get into. And so it's no surprise that it's where money can flow the fastest to. But I think there is growth elsewhere. And you just think about the infrastructure needs of many of the economies that were talked on in the previous session, and so on. All of that will require capital. And if capital is required and capital isn't there today, then the returns will generally be higher. And so I think eventually the returns will match the opportunities that are available outside the US. And you will see more and more intermediation of those opportunities and therefore assets that investors can go into. So I'm pretty confident 10, 15 years, we will see alternatives to the US that are compelling investments for institutions.
Josh, we are nearing the end of this panel. Why don't you tell us how you view this market performing over the next sort of 5-year horizon. Do you think the US election next week, how exciting, will make any difference?
Yeah, well, first of all, I mean, I think following up on some of the comments, look, I think ultimately private equity, public equity, I think there's been a massive sea change in the public markets. We've talked a lot about private credit. Public equity now, 30% of the S&P is 7 stocks. And more, there's 7,000 public companies. It's gone to 3,000. And so in the meantime, private equity, right, has had a lot of money flow into it. Some of the realizations have not been there. And so you're seeing a backup in that market. To the point that was made, I think that that's an opportunity. You have to kind of flip that on its head. It's really that, as much as, private equity has underperformed its historical returns and underperformed public equity, I think probably now's the time to be a little bit more daring and take advantage of the fact that there's less capital in private equity. To Jeff's point, that's when you want to play. And so there's a big opportunity for the right managers in private equity to take advantage of the fact that some of the big investors like Jeff and others are saying, wait a second, we want to get some money back before we allocate. I think in terms of the U.S. election, look, I think that the U.S., that might create a little short-term volatility, but I don't think, I think we'll all get through that. I think that to a large extent, that's a tail. I think there's a lot more, there are other tail risks, that I would weigh higher. I think that certainly in some of the public trading markets, you might see some volatility, but in the private asset space, I think we've all been used to many elections. Certainly this one's a little more divided than we all hope for, but by and large, the U.S. system tends to maneuver forward through these things, and I strongly believe we'll all make it through that. And actually, in some cases, it may be an opportunity if you keep level-headed and you allow for people that might, kind of move quickly to avoid it. You might be able to take advantage of that a little bit.
Would you agree, Anne? Are you feeling optimistic?
Yes, I'm actually really quite optimistic for the future. I think investors make adjustments to the changed political environments and have in the U.S. for several hundred years. So I think that the short-term volatility is offset by the long-term opportunity. Again, we'll go back to the macro backdrop. Technology investment is going to be enormous, and there's going to be a huge opportunity for investors. We talk about tokenization, but let's talk about the underlying asset classes that we're talking about too, and particularly equity investment in real estate, infrastructure, the build-out of reshoring. And by the way, that's not just a U.S. phenomenon. As geopolitical changes are happening around the globe, that's happening in other countries. Certainly, we're seeing it here in the Middle East as well. And so there's going to be a tremendous opportunity to make investments in asset categories that traditionally have been called alternative, but they really are much less volatile and much less prone to these short-term market volatility moves as we've seen in public markets and can see in public markets. Relatively speaking, this investment need is going to flow for years. And so I think there's a tremendous ability for investors to participate in this and use technology, including blockchain and other investment opportunities and alternatives to participate. So I see a pretty bright future for investors. But I agree with a lot of comments, and that is you have to be selective. You have to know what you're investing in, and you have to be thoughtful about it and do your homework. And I think that having done that, that there's going to be a lot of liquidity moving into the area. It's going to continue to attract capital, and I think we have a good future.
I think that's a perfect place to end this session. Thank you so much to our panelists for decoding the very large alternative asset space for us. Thank you so much, and I will move on to the next panel.
Thank you.